Hey, good morning once again, options traders. Well, I thought this would be a helpful video for our traders in the group to understand why your deltas can flip. In other words, from positive to negative or negative to positive, even though the stock might not be moving. And this is the bigger issue, is to understand that you get so many different moving parts with an options strategy, especially when you start getting two or three legs to them. And so with a backspread, a lot of times traders will say, oh, it's an overall bullish or an overall bearish bias, and they don't realize that just something as simple as the passage of time can flip you from positive to negative deltas. So why is that? Well, it's a good question. Let's go find out. And as always, before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is always greatly appreciated. So first off, let's do a quick definition of a backspread. We've talked about this before, but it's a strategy where we might, let's say, sell a call option and then buy two calls at a higher strike. They have to have the same expirations. Now, of course, we could do any strategy with puts as well. If we sold a put and then bought two lower strike puts, that would be a backspread as well. If you use a backspread with calls, it will have an overall bullish bias. If you use them with puts, it will have an overall bearish bias. But the idea is essentially the same. So for example, let's say that you sell a $100 call and you buy two of the 105 calls. Again, they've got to have the same expiration. But notice that we are selling the lower strike call. In the case of the puts, we would be selling the higher strike. You are selling the more valuable option. And that's one of the keys to understand. That's what we're trying to do, but we're giving ourselves some added deltas in the event that we get, let's say, a bullish or a bearish run. Now, these backspreads are normally established for a credit because in the case of a call, yes, overall we have a bullish bias. But if we can establish it for a credit, if we get an adverse move, in this case to the bearish side, we'll at least have some little tiny profit to show for it. So for example, if we were to execute this strategy right here, the 100-105 backspread with calls, this is our risk graph. So here's our short 100 call, and if we were just short that call by itself, notice our risk graph would do this. We would have these unlimited negative deltas up here, unlimited risk forever. But because we've purchased some 105 calls, that's no longer true. But notice that if I just purchased one 105 call, we would flatten out this way. It would just be a vertical spread. It would be a credit spread or a bear spread. But when I buy that second call, now we get these nice positive deltas out here. However, normally when we put these strategies on a backspread, we will structure them with the current stock price right here at the strike of the long, in this example at 105. So let's say the stock is right here at 105. Now remember that the black line is the expiration graph that shows the profits and losses right at expiration. Let's call it 3:59 p.m. Eastern Time on expiration day. That's the only time that this black line applies. The green line is called the current curve. That's what we look at today. But as time passes or volatility changes, we're going to find that this green line is going to move. So at a minimum, we know that time is going to pass. So in this case, let's say this green line maybe after 2 weeks is going to move towards the blue. And what you're going to find is over on the left wing, these lines are moving towards the black. We have positive theta, but everything to the right is starting to sink. We have negative theta. Now also we can get these lines to move from falling volatility. If volatility falls, let's say from 40% to 35 to 30, it's going to move from the green to the blue and eventually down to the red and ultimately to the black. But that's what's going to happen over time. We would also see it starting to shift higher on the left. Again, that's if time passes or volatility falls. We would get the opposite effect if the volatility were rising or if we happen to put on a backspread with more time until expiration. But what gets interesting here is that as we do that, if we were to use a longer dated one, that these out-of-the-money options are becoming more in the money, relatively speaking. That's the Trumpification effect that we've talked about. and that means that they're becoming more positive. Over on the left, it's becoming more out of the money, relatively speaking, again because of the Trumpification effect, which means that these negative deltas are starting to have less of an effect. And so we become even more bullish. We end up with more positive deltas. So we just work that same process in reverse. As we start sinking, look what's happening to these two long 105 calls. Remember, they're at the money. Stock is 105, we're long two of these. So those deltas are going to move from roughly 50 deltas towards 0. What about this short 100 call that's in the money? Well, those deltas are going to go from maybe short 80 delta to short 100 deltas. And so overall, those deltas are going to get pushed towards -1. And that means that the strategy is going to move from positive deltas to negative deltas from nothing more than the passage of time. Now, there's a lot of different strategies where that could happen, but I think the backspread is one that is a lot of times overlooked by traders. They don't realize that that can happen. I think there's a good way to show that effect. But the main thing to learn from all of this, even if you never plan to trade a backspread, is that things change. That's the simplest way to put it. Your time at a minimum is going to change, but the stock price is most likely going to change. You're going to get changes in volatility. You potentially could get changes in interest rates. But at a minimum, you need to understand how the stock price, time, or volatility change, and recognize that all of your Greeks change. And again, at a minimum, time is going to change. And so the point is to be sure that you understand how these relationships work regardless of the strategy. And you need to understand that before you even put your first strategy on. Because if you don't, you're going to be making bad decisions and, in the worst case, be left with some very unwanted surprises, even if the stock moves in your favor. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.